Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. And I'm very proud and actually excited to be able to share with you another FastGraphs Value You Academy on a subject that I consider to be one of the most important subjects that investors need to really not only possess but also comprehend and understand fully, and that is the power of compounding, the magic of the power of compounding. An old urban legend states that Albert Einstein once called compound interest the most powerful force in the universe. Now, whether or not Albert actually said that or not is a matter of debate, but if he didn't say it, all of us here at the Value Academy wish he would have said it because we really believe it is that powerful. So with this part A, I'm going to be introducing some concepts of just how powerful compounding actually is. So let's go ahead and move forward here into the presentation. It all starts with an old rule of 72, something many of you hopefully are already familiar with. It's an old investing principle that's really a shortcut. It helps you understand how money works and how compounding works. And you just simply take any rate of return and divide it into the number 72, 5%, 10%, 20%, etc. And it tells you how many years it takes you to double your money. It really comes down to the time use of money and how important time is as it relates to investing. So when I was first entering the business, my economics professor, and later became my partner, or I became his partner, I should say, in business, in a money management business, showed me a little exercise that he did on the back of a napkin. And he said, if you invest $20 a month, in other words, that's $240 a year, $20 a month times 12, $240 a year. And he said, let's just assume you did that for 36 years, and let's call that a hypothetical working life. By the way, as you'll see here in a moment, the 36 years really helps make the math work here. He said, and if you earned 10% per year, that $240 a year, $20 a month would grow to approximately $80,000. Then he asked me a question. He said, so if you make $80,000 at 10%, how much money would you have if you doubled your return to 20%? And I've shared this with a lot of people, and you're going to get a very common answer is going to be, well, double the returns, double the money. Instead of $80,000, I'll get $160,000. But that's not how compounding works, and let me explain. The rule of 72 says that at 10%, if you divide 10% into 72, it will take you 7.2 years to double your money. If you take 20% and divide it into 72, it'll take 3.6 years to double your money, or half the time. And as a result, by earning 20%, you actually end up with 19 times more money. Instead of $80,000 at 10%, if you invested at 20%, you would have $1,500,000, or just under 19 times more money. So how does this work? So let's examine this. At 10%, your money doubles every 7.2 years. At 20%, your money doubles every 3.6 years. So if you double your rate of return, what you do is you cut in half the time it takes you to double the money. So using this accommodating math here, if you have a 36-year time frame and your money doubles every 7.2 years at 10%, that means you'll get 5 doubles over 36 years. But if you double your rate of return, you've cut in half the time it takes you to double your money. So in that same 36 years, doubling every 3.6 years, you're going to get 10 doubles. So here's what that looks like over time. Let's just track the first dollar we invested at 10% over 36 years. Let's forget about all the other contributions. This is where I think you can really get the essence of compounding. So if we're doubling our money every 7.2 years and we divide that into 36, we get 5 doubles of that first dollar that we invested. So that first dollar will grow to $2. That's 1 double, 4, 8, 16. At 5 doubles, you end up with $32 over 36 years. Your first dollar increased by 32-fold. That's powerful in its own right, and that's the power of compounding. But if you can be lucky enough to earn 20% a year or double the rate of return, you're now doubling your money every 3.6 years, so you get 10 doubles. So that dollar, instead of doubling 5 times to $32, it doubles an additional 5 times. 32 doubles to 64, to 128, to 256, to 512, or $1,024. That's 32 times more money at 20% if you could earn 20% over 36 years than if you only earn 10%. So the point is, this is all about compressing time. It's about doubling your doubles, not doubling your money. And again, the time use of money is so critical to understand with investing. Now, of course, the question that comes up here is, yeah, but how are you going to earn 20% a year? In fact, how are you even going to earn 10% a year? You know, the average rate of return that stocks have delivered over 200-year time frame has been about somewhere, but some people will say 6%, 8%, maybe even as high as 9%. And of course, it really depends on the time frame you're measuring and the valuation at the market at the time you're measuring. But the reality of it is, if you invest in quality common stocks, you can earn rates of return. McDonald's grew by over 30% a year for several decades prior to about the early 2000s. Microsoft did a similar thing. We now, in today's world, we have companies like Amazon. And I'm using operating cash flow here because, I've always said, and I've said it many, many times, and I think it's important that investors understand this. In the long run, fundamentals are what determines your rate of return. And the value of any business that you can invest in, or any investment for that matter, but any business for sure, is going to be determined by the amount of cash flow it generates for its stakeholders. So what I'm going to do here is I'm going to look at Amazon going back to the year 2003. I've got roughly 18 years here of time, and I'm going to look at it from the perspective of operating cash flow and operating cash flow growth. Now, the first thing I want you to understand here is that if you use the rule of 72, if you take 34% and divide that into the number 72, you will discover that your money is going to double about every 2.11 years. Now, the problem is the math doesn't work out that clean. Like if I look at the bottom here of Amazon, you can see they had 103% cash flow growth, 43%, 29, then minus, then 100, and so on and so forth. But it averaged out at 34% per annum. So in essence, Amazon was doubling its operating cash flow about every 2 years. And as a result, their stock price, as you can see, clearly tracked operating cash flow. And I'm using a priced operating cash flow equal to the growth rate of operating cash flow of 34. But you can see that's almost a perfect fit. The stock price has really tracked that. The business that Amazon has produced, the business results that Amazon has produced is what generated the shareholder returns. Now let's look at that from a perspective of how powerful the magic of compounding is. So let's go to our performance graph here and let's look at a $10,000 investment in Amazon made on December 31st, 2002 and held till December 17th, which was Friday's close of 2020. That $10,000 would have grown into $1,713,116. Now compare that to the average, which I mentioned earlier in this presentation, the average stock as measured by the S&P. The S&P would have taken 10,000 and including dividends turned it into $48,479. That's obviously a vast difference. To put that into further perspective, by Amazon growing their operating cash flow at over 34% per year, the company ended up turning $1 or $10,000 into 170-fold, into 1,713,000. That's a 170-fold increase. So if you remember the doubles there that we talked about, at 20%, you got 10 doubles. This is an 18-year period. What you end up with here is about 8.6 doubles, or just under 9 doubles. So at 10 doubles, if you recall, we turned $1 into $256. And, at the 9th double, it was $128. So here we're at 170. That's right between the 128 and the 256. Here's a real live example of a company, a business that was able to generate a 34% growth of their business cash flow year after year for the last 18 years, gave their shareholders the opportunity to generate almost an identical, 33.1% annualized rate of return, totally consistent with the 34.02% growth rate. Now, obviously, Amazon is a great story, a great growth stock, and it really does kind of, give you the ultimate in the power of compounding and understanding the power of compounding. But there's also a more conservative side to that. This has been part A of a 2-part series on the power of compounding. Part B, I'm going to ask Professor Bill Kay to go ahead and dig a little deeper into the power of compounding and talk more about some of the nuances, because the bottom line is we really want you to understand how important compound interest really is to investors in the long run. So in part 2, I'm going to turn it over to Bill Kay. Thanks for watching, everybody. If you like what you see here, don't forget to subscribe to our YouTube channel, Fast Graphs Value U Academy. And give us a like and a thumbs up, by the way. We'd appreciate it.